We've got a new loan product on the market that some experts are saying is going to lead to disaster, and that's what we're going to get into in this video.
The housing market right now consists of high mortgages, expensive homes, and low inventory in many areas. But are zero down mortgages the answer? Some say they come eerily close to the loans that caused markets to crash in 2008. The policy is designed to help homebuyers who can't afford that initial payment, but it could come back to haunt you if you want to move or refinance. People who opt for zero down mortgages rely on a good economy and trust that their home's value will actually increase. So let's bring in an expert here.
So recently, America's biggest mortgage lender announced a new loan type, which is 100% financing, which means a buyer can buy a house with zero money down. And that is riling up the critics and drawing comparisons to 2008. So let's look at this loan type and see if this really poses a major threat or not. First of all, I want to point out that 100% financing options, it's hardly groundbreaking. We've had VA loans for veterans since 1944, and the USDA has been offering 100% financing initially to farmers. This was like a New Deal thing, trying to overcome the effects of the Great Depression. Back in 1937, they started offering 100% financing to farmers, and that loan type still exists, although it's not necessarily geared just to farmers anymore. It is a rural development loan, so if you find a home in a rural area, sometimes this loan type can help you buy it with no money down, which is great. Loan types come with rather rigorous appraisals, and that kind of makes sense because if you think about it, the buyer has no skin in the game, right? So they're going to be looking to make sure that the home is in really good condition, that the value is there, because it would be very, very easy for a buyer to walk away from a home that they have not put any money down on, as opposed to somebody who's just shelled out, 10% or 20% of their hard-earned money in order to buy this home. See the difference? That's important. That's one of the things that we're going to get into. VA loans and USDA loans, they have limited application because you either have to be a veteran or you have to be searching for a home in a rural area, which isn't everybody. But there are other loans that are very similar already in the market and have been for a long time also, and those are 1% down loans and 3% down loans. This is not fundamentally different from a 1% down or a 3% down loan. There's not that much difference between putting nothing down and 1% down, but it will attract a lot of attention.
Okay, all right, I see where you're going.
Think about it. You walk into a video store, you see 8-minute abs sitting there. There's 7-minute abs right beside it. Which one are you gonna pick, man?
I would go for the 7. Yeah, I'd go for
bingo, man, bingo.
So I'm in Central Florida, and the real estate market everywhere is hyper-local, right? So what I see happening here is not necessarily what's happening in your market. Keep that in mind. But in my market, it is very difficult for mortgage lenders, just general mortgage lenders, to compete with what new construction communities are offering. So if you walk into a new construction community, I'm not talking about a custom build, I'm talking about national home builders that are putting up these communities where there's 4 or 5 different models and you don't really get to make any choices or design choices in your home, but they will pay, by and large, the bulk of your closing costs, if not all of them. And they purchase points up front so that they can dole them out for certain, homes that they need to sell. They'll run specials, they'll run, 4th of July specials and things like that. I anticipate we'll see some big deals coming up soon for that. And they will buy down your interest rates. So some of these communities are offering interest rates as low as 4.5%, 5%. Compare that to what's out on the open market, 7.5%. It's a tough deal to beat. So I feel like in my Central Florida market, this loan could be competing in that it's another incentive, a way to buy a home with no money down for buyers who are otherwise looking at new construction. It might make the mortgage more competitive. Okay, so here's how this loan operates. It's not for everyone. You either have to be a first-time home buyer, and that is defined as someone who has not owned a home in the last 3 years, or at least one person on the loan has to fall into that category, or you have to make 80% or less of the area median income. So here's a breakdown of how the loan works. They're giving you 2 loans. The first loan is a conventional loan that covers 97% of the purchase price, and the second loan covers 3% of the purchase price, which would normally be your down payment. It maxes out at 3% or $15,000, whichever is lower, and it is repayable in 30 years. What's interesting about this loan, the second loan, is that no payments are required, so you can forget about it for 30 years. That is different from other loans that I'll talk about a little bit later, which are grants that you don't need to repay. Now, at first glance, I was thinking, and many critics have pointed out, that this seems to be aimed at entry-level buyers or maybe low-income buyers, but that really isn't the case. And I'm going to drop a link to the website that you can jump on and check out what 80% of your area median income is. For Central Florida, the area median income is over $90,000, so 80% of that is $72,000. So that's the maximum you can earn, but we're not talking about it being aiming at low-income families or minimum wage employees. You just have to earn less than that. So now that we understand how the loan works, let's delve into some of its implications. So this is where critics start to get concerned. Let's say you've opted to use this loan. So you've bought a home with no money down. Unless you've paid your closing costs, and some people manage to get the seller to cover most of their closing costs, your investment is very limited, possibly nothing, which means you have very little vested interest in this property. This also means that you're stepping into your home with little to no equity. Equity being the difference between the amount that you've put down or the amount that you've invested in the home versus what it's going to sell for. And those two numbers immediately are the same. So let's look at an example. Let's say you've used this loan type and you've purchased a $300,000 home, which falls within the amount that would be possible with this loan. And life happens and you need to sell it pretty quickly. So you're not going to probably sell it for more than $300,000 because home prices aren't soaring like they once were, at least again in my market. So let's say at closing you net $270,000. Well, if you didn't have the cash to put down on the house when you bought it, chances are you don't have it now, which means you're coming up short. So in this scenario, we're looking at things like a short sale or possibly foreclosure or people walking away from the home altogether. They don't have any money down. So there's very little tying them to the house, unlike in the situation where a seller has put down 10% or 20%, which in this scenario would make it easier to sell. They wouldn't have to come up with that money at closing. They wouldn't be making any money on the home, but they wouldn't have to come up with a big chunk of cash at closing in order to be able to walk away from this property. If prices begin to decline, you would be more likely to walk away from this home because, again, you don't have any money invested in it. And that's where it does start to parallel 2008, the potential for people to walk away from their properties. And then there's another scenario that troubles me, which may sound ridiculous, but believe me, I've seen it happen. I've been doing this since 2009. I've seen all kinds of crazy things happen. But that's where you decide to sell your home, 30 years have passed, you don't even remember that you have this loan. Or the spouse that took out the loan, who was the financial guru of the family, has passed away and the other remaining spouse doesn't remember it or know about it. That's going to create a problem down the road. Now, hopefully there's enough equity to cover it, but if you want to refinance your home, let's say interest rates go down enough that you want to refinance, you'll have to pay this loan off. Or if you want to pay off the first loan, you're going to have to pay off the second one as well. So there is that element of possible surprise down the line for this. Now, there are alternatives available to this loan type. As I mentioned already, there are grants that are available from your local government to various lenders that also offer grants that will come with a higher interest rate, but they don't have to be paid back, provided you stay in the house for a certain number of years. And the governmental level grants you can find by speaking to a lender in your area. They usually run out of that money really quickly, so if you know of one coming up, you should start to look at that well in advance and get yourself in line for it. My name is Krista. Thank you so much for tuning into my channel. I've been a realtor in the Central Florida area since 2009, and if you'd like to speak to me about your Florida real estate needs, my contact information is always below this video. If you're watching on a phone, just click on the title and a whole bunch of information will populate, including a link to my calendar. You can click on that and set up a time to speak at your convenience. If you're interested in maximizing your potential net when you sell your home, don't miss my seller's guide, which is also linked below this video. Now let's look at what UWM itself has to say about this loan program and why they devised it.
The biggest obstacle to home ownership is the down payment, and this down payment assistance program solves that for most consumers across America.
Now, there are definitely borrowers out there who genuinely lack the ability to save money to buy a home, but in my experience, it's not really the case. Most people are going into this understanding that they have to have something in savings in order to be able to buy a home. For those who don't, this could bridge that gap. But what I see a bigger hindrance to home purchasing right now is, again, in my area, the cost of insurance, the cost of homes, and the interest rate. And what does that equal? Well, those three things come together to make a very high monthly payment. And that is what most of these entry-level buyers are more concerned with. Rather than not having anything in savings for a 1% down loan, It's what is the bottom line? What do I have to come up with every month? And that's the bigger deterrent. And interestingly, with this loan type, that's actually probably going to be the biggest reason why people don't want to use it, because you're not putting any money down. And so you're paying basically the maximum amount every month. You have no equity. You didn't put down 10%, you didn't put down 20%. So you are at that maximum monthly payment. Now, I did hear that that UWM received 2,000 applications in the first 2 weeks after announcing this loan type. So maybe I'm wrong, but I wonder how many of those will actually go to closing when people understand exactly what their monthly payments are going to look like. For that reason, I don't see this as being a huge threat. Critics are saying that it could be another 2008, but I feel like this is going to be a fairly limited use on this loan. So we'll see what happens. Thanks for watching, and I'll see you next week.